All right. Good morning, everyone. I think anybody that's taken a flight is going to kind of know this feeling that I'm going to describe for you here. So you're about 3 hours in. You've hit kind of cruising altitude. You found the perfect movie on the in-flight display. You got your ginger ale. You got your pretzels. And you're feeling super comfortable. And then all of a sudden, the plane kind of starts doing a little bit of acrobatics that you didn't expect, and you feel that drop. So you've hit a period of turbulence, and not the fun little giant con either. It's sort of time for that fasten seatbelt sign to come on. And it kind of feels like the fasten seatbelt sign has been on for the mobility space and the economy for the last 2 years. And so that's why I'm really excited about this panel that we're going to kick off this morning. It is called Navigating a New Investment Climate for Mobility Innovation. And we have a trio of folks here who are way smarter than me that are going to run through it. But before that, quick housekeeping note. There's a pair of microphones about halfway through the room here. And we're going to actually ask for any sort of audience Q&A today. So if you have a question for the panelists here, just line up behind those microphones and we'll have an opportunity to hear from you. So before we get into it, again, I'd love to kind of hear from the panelists. Geordan, you have either the blessing or the curse of sitting beside me, so you get to go first here. So tell me a little bit more about your background and your firm's focus.
Great. I'm with Renewal Funds. We're a Series A climate investor based here in Vancouver. We invest in transformational startups that are primarily helping utilities, governments, public agencies decarbonize and advance sustainable infrastructure. So we are big investors in the energy transition, sustainable water infrastructure, and then mobility and transportation is a big focus for us. So we're a little bit unique or weird or Canadian as a VC, compared to a lot of more traditional sort of Silicon Valley-based venture investors, where there's been this idea that if you're a innovative startup, you can't really interact with governments because governments move too slow, and you're a startup, you have to move fast and break things. And all the drama with Uber and a lot of local municipalities over the past few years, we've kind of taken the opposite view of that governments really need startups to develop innovation and help them advance towards more sustainable infrastructure. And startups selling into governments can actually be incredibly successful. So one of our really exciting investments that we led about 4 years ago is in a company called Swiftly, which is advanced data and software for transit agencies to help improve on-time performance of their system. And if you're a rider, deliver an experience that's a lot more like taking an Uber, where you can see your bus exactly where it is, when it's going to arrive, how crowded it is, when you're going to get to your destination. So those are the types of companies that we get really excited about, that are helping all these 100-year-old transit systems or old 100-year infrastructure become more modern, more sustainable, and decarbonized.
Hi, everyone. I'm Diana Zhou. It's so great to be here. I always love coming to the CoMotion Motivate conferences. I think they're some of the most fun conferences in the world. So thank you for having me here. I'm one of the venture partners at Eclipse Ventures. We are based in Palo Alto. We're a $4 billion fund investing in physical industries. We're primarily focused on what we call the industrial evolution or the new economy, so things that intersect the physical world with the digital world. We like to call it the intersection of bits and atoms. We invest across the entire life cycle of a company, all the way from seed, Series A, B, C, and so on. We invest primarily in industries like energy, transportation, mobility, construction, defense, et cetera. Basically anything that touches the physical world, we'll invest in that. I joined as a venture partner about 1.5 years ago when we were starting out a relatively new group at the firm at the time. It's called Venture Equity. And I work with founders to build companies from the ground up. So I will work with founders to basically come up with an idea, a thesis, we call it, take it through about 4 to 6 months, work with them essentially as their interim co-founder, work with them to figure out product market fit, what is the thing that we're going to go build, what is the technology wedge, and then and to ultimately pitch it to our investment team for seed funding. So it's a program called Venture Equity. If any of you guys are founders or know founders who'd be interested in it, please come talk to us. Would love to talk to you guys about it. My background is, before coming to Eclipse, I was at a company called Virgin Hyperloop. We were building Hyperloop technologies across the world. I led our go-to-market and commercial strategy for the US and European markets. So did a lot of work with selling to governments, selling to various cities, various regional organizations, as well as with the Federal Department of Transportation to figure out how are we going to regulate Hyperloop, what was that going to fall under, the FRA, the FAA, et cetera, how are we going to fund and finance it, so can speak to all of the challenges and fun parts about building infrastructure in this country, and I think it's such a tremendous opportunity that we have here. We're also at such a critical point in our nation's economy, and it's really fun to be on the investing side now and think about where should we be investing in what kind of new technology. So super excited to be here today.
Hello, Sara Jones. I'm an advisor and former SVP for New Vista Capital, which is an investment firm founded by the former chairman and CEO of Boeing that's focused on emerging technologies in aerospace and defense. Some of our portfolio companies include, for example, Aero, which is working on a towed cargo glider concept that's able to reduce fuel usage and emissions by 65% per pound of payload, which is pretty exciting, and they're entering the market in the very near term compared to other technologies in the space. And I'm also an advisor for Sustainable Aero Lab, which is an accelerator, an international accelerator based out of Europe that is for pre-seed, seed, and Series A companies that are working on decarbonizing aviation. So it's the only accelerator focused specifically on that mission. And I'm personally, my background included being at Boeing and leading innovation strategy there, as well as helping to found Boeing Horizon X, which was the innovation and venture capital arm. And I had the pleasure of not only leading innovation teams, but doing things like launching urban air mobility pilots overseas and things of that nature. So I've both been an investor, an advisor, and an operator. So I love partnering with entrepreneurs in the space to be able to move forward, particularly on how we will decarbonize aviation.
Amazing, and it's going to be fun to have sort of three really interesting and somewhat different perspectives on what we're going to dive into today. And I think it might be nice sort of to contextualize the space kind of where we're in first to kind of kick things off. So it kind of seemed like the gold rush in the space happened, about 2 years ago. There was exits, there was high valuations, there's lots of late stage capital, and it kind of maybe feels like that's done a 180. Is that something that you're sort of seeing in your field, or where sort of is the current investment climate like? Can you kind of be a meteorologist for us, Geordan, and kind of give the climate report?
I don't know what you're talking about. It's been an easy peasy past couple of years for sure. No, it's been challenging. I think for startups in particular and founders in particular, there was a lot of capital and a lot of signaling 2 years ago that you really needed to be raising a huge amount of capital, take a lot of dilution. Valuations were high, so that helped, but there was a lot of pressure from the investment community to be growing as fast as possible, spending that capital. So even if you were a company that raised, say, $150 million at the peak in kind of 2021, a lot of companies are finding themselves running out of that cash because they had boards and investors that were encouraging them to grow at all costs. Interest rates were low. Public markets and growth stage investors were pulling forward their cash flow forecasts and were willing to accept investing in companies that weren't going to see cash flow or revenues for 4 or 5 years. And all of a sudden that changed kind of almost overnight. So it's been a really tough time, I think, for a lot of founders, and I think companies that were disciplined in how they spent their cash are in a great position right now. By and large, I'd say a lot of startups are trying to raise capital this year, having kind of spent the past 2 years spending down those balance sheets. And it's a very difficult time to be raising money.
Yeah, I would certainly agree with that. I think it's very difficult, and I think to ignore that is perilous. So it's certainly very difficult. But I also think I think the fundamentals of the economy are there for at least some of these mobility related companies. And I think what we are advising a lot of our companies to do is to really focus on the product, on delivering the product, on getting that product market fit right, understanding what your customers want and why they want that and how much they're willing to pay for that, and really drive kind of getting to the commercial traction, getting to a good product market fit. So I think you're starting to see a lot of focus for these companies, which I think is a good thing.
So I had the pleasure and misfortune of being part of a SPAC for 2 years. So really got to see firsthand the function or dysfunction in the public markets over the last 2 years. And what I particularly saw in the advanced air mobility space, it was a very exciting time because we just have not had that influx of capital into aviation like that. And I think net, it has been a very good thing to have that influx in capital. We touched on that it really pushed up valuations. The other behavior it drove was this kind of like winner-take-all mentality, including around the ecosystem. So what we were seeing was a lot of pitches and decks and business plans that would say things like, I'm going to introduce a hydrogen aircraft and I'm going to create all the distribution system that goes around it too. I'm going to have an urban air mobility vehicle. I'm going to have the digital passenger system, and I'm going to be an operator. And I think what has happened since then is because we've had a pullback in capital, particularly late stage capital, and I would say, just one anecdotal data point is that there's 3 times the amount of demand for the availability of late stage capital right now. What I've been seeing is that people have been, back to your point, really focusing, and that means walking back from those business plans that said we were going to do everything and really focusing on the core of what they were going to deliver, which if it was the hardware, then really focusing on the hardware and starting to hit those technology milestones. But like I said, net, I think it's been positive for the space to have this much attention and to get people's imaginations going.
Do you mind if I jump in?
Absolutely.
So a lot of the companies we're investing in are digital startups. So even if they have a hardware component, it's more IT oriented. A lot of our companies are software companies, and it's it's quite a bit easier for a software company in this environment to scale back their spending. Zero marginal costs. It's just easier to get cash flow. But if you're building, physical infrastructure, if you're developing a plane, advanced manufacturing, it's a lot harder to do that. So how have both of your companies just kind of managed through that in terms of like headcount and some of that fixed expense that's like critical in a physical environment?
I think you're right. It is a lot harder. So it's harder because you can't just put a product out and kind of get market feedback and see how it works and kind of tweak it here, and then 6 months later you have something else. You really have to know exactly what you want to go build, because it's going to take at least 1 to 2 years before you can have that product out in the market and get that feedback. So the sales cycle is just that much longer. The product development cycles are just that much longer. So it's really important to get it right the first time. I will add that there's lots of available types of capital right now. So there's VC funding, which a lot of people kind of think of first when they think about funding startups. But for some of these facilities, for some of the companies that we work with that have big manufacturing facilities, and I think of some of our companies like Arc Boats, which is making electric boats. They're based out of LA. They are expanding into a manufacturing facility, for example, and there are ways that you can capitalize that facility where you don't have to take really precious VC dollars and fund that capital. So you always fund that facility. So you always want to be thinking about what kind of capital pools do I have available, and how can I deliver the best returns based on how expensive that capital is. So right now, there's a lot of capital that is coming from the US federal government to help finance some of these facilities. And when we think about battery facilities, when we think about additive manufacturing facilities, when we think about automotive manufacturing facilities, those are all facilities that require a lot of investment, hundreds of millions of dollars of investment that can be funded using loans and debt and federal financing programs, as opposed to venture capital dollars, which are probably better utilized developing the technology.
Sorry, go ahead.
So yeah, what we've seen, especially in aerospace aviation, I mean, we already have the challenge of our development timeframes not falling in a typical VC window. So if you think about a normal airplane program, it can take over a decade from design all the way through all the design reviews into production to entry into service. And so, I think what's been really critical is identifying early stage non-dilutive grants and funding opportunities. And so what I've seen from a lot of companies that I advise or that I've vetted is that there's an emphasis on dual use. And so dual use means selling both to government and to commercial. And that has really been a lifeline to the extent that I often joke that the DoD is going to fund the green revolution in the US. So, that's been SBIRs and other types of grants from AFWorks, DIU, and others has been pretty critical. And then in the US, what we're also seeing is if you dive into the Inflation Reduction Act, there's a number of funding avenues, whether it's grants, tax incentives, or loan structures that can be utilized, fortunately, at different stages. I think we're still underfunded for the early stages in terms of federal partnership and public-private funding opportunities. But, as Diana was saying, within the Inflation Reduction Act, there is money earmarked for loans up to 80% of project financing for things like battery facilities. There's money earmarked even for vehicle manufacturing for those facilities. So I think if a company is in that, C, D rounds or later where they're actually into production or into developing the production facility, there are some very, very exciting channels now. It'll be interesting to see, especially since so much of it is focused on tax incentives, what kind of creative structures develop. So for investors in the room, you should start thinking creatively about how do we put some structures of funds in place that allow us to tap into those tax incentives, because in a lot of cases, they are transferable, and it could start to get return profiles into the place, especially for hardware, where it could attract different types of risk capital. So I'm excited to see what comes out of it. It's still pretty early. It's still pretty early to tell, but it should hopefully be the catalyst at least.
I started listening to this tax equity podcast as I'm falling asleep. It's like the perfect thing to make you go to bed. So,
as I'm falling asleep, maybe isn't the best advertisement for a podcast, but we'll let that one slide. Hearing some kind of rumblings from you three about the role of government, and I think that's perhaps a thread that we should try to pull on a little bit here. Would definitely like to hear from Geordan and Sara on this too, but Diana, I know backstage we were talking about Eclipse, and they've hired, I believe it was a government affairs consultant.
Yeah. So we took a look at our portfolio companies, and as investors, we're very, very actively engaged with all of our portfolio companies. We usually take a lead position in any funding round, and we will sit on the board, and we will have weekly, bi-weekly calls with the CEOs and founders too. And this kind of gets to the point that you were talking about earlier, Geordan, to really make sure that they're on track to build the right product, being mostly hardware companies. I was chatting earlier, and one of the things that we were looking across our portfolio, and we realized that actually a lot of these companies that we are invested in are in areas that are of strategic national importance to the U.S. government. So Vulcan Forms, which is a 3D printing company, they use laser arrays to to print to print metal, and it's really, really cool what they've built. They're based out of Boston. They are a huge additive manufacturing facility, and they're continuing to do a lot of great work. As well as some of our other companies like Bright Machines and Oxide and others. We realized that a lot of them had a government angle or were really interested in selling to the government. So we did a survey of our portfolio companies, and roughly 75% of them said they wanted to have some kind of government engagement strategy. And many of them didn't know the first thing about selling to government, working with government, how to navigate all of that. And if you think about it as a startup, especially an early stage startup with 20 people, 50 people, even 100 people, it is a daunting task to think about how do I navigate this ecosystem, and where do I go, who do I talk to get access to these things that I'm reading about in the news, like the DOE's loan program and all that kind of stuff. So we hired a government affairs consultant, some very senior White House officials that worked a lot on putting some of these programs together to help our companies think through how to get access to that kind of funding and financing program. And it's been we just rolled this out a couple of weeks ago, and it's gotten tremendous traction across our portfolio companies. They love it. They're really excited about it. And I think many of them are really actively looking at how do I engage more with government. So we're seeing a really strong pull there.
So at New Vista, I think we benefited from, of course, Dennis's background with Boeing and understanding, the way they've structured their businesses. They have their defense business unit, they have a services business unit, and commercial business unit. And it's been very helpful because commercial is very much impacted by economic cycles, whereas defense isn't. So we had that learning already coming into forming New Vista. And so we're very fortunate to have a group of advisors that includes people like former General Marianne Miller, who ran basically all of air logistics, former General Sebby Wilson, who was vice chair of the Air Force, and H.R. McMaster, who ran the NSA. And so we have folks like that that have a very deep understanding and contacts across the government. So that's been very helpful for our portfolio companies. And then at the portfolio company level, we have also brought on it. For example, Airlane has advisors that are government and regulatory advisors. And so I think if you want to move fast, particularly if you're creating anything that has to be certified or you want to sell to government, really making sure that as a startup you are tapping those advisors early is critical, because one thing we always say is you can't minor in government. And the reason why we say that is not only do you have to navigate the channels to sell properly, but then there are implications when it comes to, do you have international employees, your accounting, because you don't, how you've structured your business and accounting, because you don't necessarily want to be sharing all your cost information from your commercial side to the government, because some of that does need to be disclosed when you're bidding for contracts. So it's things like that but if you get a really good advisor in your court, you can begin to tap into those things in an intelligent way.
I'm curious as well, too, sort of on the policy side, what regulatory changes and incentives can government sort of enact that may stimulate private sector investment?
I can start. So I think we always talk about, government and regulations and legislation as if it's kind of like this thing that a lot of startups have to go through in order to get more private funding. But actually, I think I would encourage a lot of governments to actually think of themselves as the customer, because governments spend a lot of money. They spend a lot of money on transportation. They spend a lot of money on defense. Spend a lot of money on infrastructure. And I'm talking about federal, state, local, cities, like all aspects of government. And actually, many of our portfolio companies' customers are government. And so when we think about how do we help our portfolio companies or what do we look for when we meet new startups and think about them for investment? A lot of that criteria is, well, how many government contracts do you have if that's kind of your main line of business? And I think there are ways in which governments can be a little bit more transparent about what their priorities are and what is really going to move the needle for them, and also different types of contracting methodologies so that it's easier to get contracts with the government to be on the list so that startups can actually apply for certain types of programs. So I think there's lots of ways in which government can send a signal to the private sector and to startups about what they want and help those private sectors, companies kind of access that.
I'd probably just add that I think, at the same time as the availability of early stage venture capital and growth stage venture capital has really tapered off the past couple of years, there's never been a better time, just in terms of the set of incentives supporting you as a company if you are in decarbonization of transportation, decarbonization of the energy grid. The Inflation Reduction Act is transformational. The Infrastructure and Jobs Act, transformational. The quarterly policies up here in Canada are having a really big impact. And so, at one level, I almost think the ecosystem doesn't really. These are phenomenal policies, and they're taking a little while to sort of trickle down, and the mechanics of like tax credit transferability, like all that stuff is being worked out. But I think in 2024 we'll have a lot of certainty around that, and startups haven't had that certainty, in the climate tech space. Every single year, there's these threats of the investment tax credits not being there. Now we've got a decade of certainty to go build. As a mobility investor, amongst other things, the things I get really excited about are, things like congestion pricing or removal of parking minimums in, urban development, densification, all those things that you really need to build a really rich sort of shared mobility and, decarbonized digital transit ecosystem. So it's kind of a bummer when things like, congestion pricing in New York are hung up for 2 years in environmental review, because I think those are the types of things that really will be transformational for the ecosystem to allow, really innovative, new modes of transportation to develop and flourish.
So from the aviation perspective, I think that probably the most important thing from a policy perspective is any kind of regulatory clarity and certainty. I think the big hang-up for where we have been from a technological perspective, particularly around autonomy and the beginnings of electric aviation and hydrogen, it has been around the regulatory front. So if you could take drones, for example, we already have the technology today. There's a lot of use cases. There's a lot of companies working on it. In the United States, at least, you still can't operate beyond visual line of sight without an exception. So it's things like that that have just, because there is no regulatory clarity and there's just, it stymies innovation and it stymies the ability to go to market. And then the other piece, I would say, I echo the comments that it's a very exciting time. When you look at the unit economics, because a lot of mobility is commodified, particularly air travel is very commodified, right? The people pick price, and then they pick schedule and frequency for what they want in an airplane ticket, for example. So when we look at things like sustainable aviation fuels, unit economics is one of the number one reasons that it hasn't scaled yet. And so I think the industry is working really hard on putting demand signals out there through book and claim and other things like that, and offloads. But we still, from a unit economics perspective, the incentives to get that off the ground are still critical. So I was very happy to see, the current administration earmark funds to help with the unit economics. But I think we need to continue to decide if we as a society want to invest in technologies that do truly help decarbonize and move us along that path, that we have to recognize that the market won't work perfectly to make that happen if the unit economics are wrong. So Yeah, I'm all about the carrot over the stick because in aviation we have a lot of regulations. So I don't know that we need more. We probably need some more incentives.
Amazing. So we have just under about 10 minutes left. Just a reminder to the audience, we definitely encourage questions. So if anybody has any, there's a pair of microphones in the middle of the room, and we would have time for about one or two. Well, I'm seeing some movement and making sure that's not grabbing a second cup of coffee, that is a question. Oh, okay, amazing. Dive in.
Oh, hi, I'm Al Walker from TransLink. I'm interested in hearing the speakers talk about decision-making culture. I hear so many decisions, and some of them are big bets from a venture capitalist perspective in terms of what companies you would invest in. I'm hearing some other big decisions if some of you are on some of the board of directors for some of these companies, and then there's also big decisions for implementing these projects in a hurry, such as a new plane, for example. I was just wondering if you could speak to what you think is successful in a decision-making culture perspective for your companies and the different companies that you work with. Thank you.
So I think the ability to make decisions without perfect information is critical. So when we think about at the systems level, no one knows which technologies will actually be the technologies that truly solve these problems. So the ability to have a commitment to moving out on things that are imperfect or we may not know is the true solution. So there's a lot of arguments in aviation. Is it hydrogen? Is it electric? Is it SAF? Well, it's all yes to all of the above. And then in terms of, so at the systems level, it's that ability to spread some bets and decide that the outcome that is worth taking the risk of being wrong in some cases. And I think that holds true at the startup level, which is the ability to move down a roadmap without perfect information, but do it in such a way that you're creating a constant feedback loop with all your stakeholders, whether it's regulatory, customer, communities, and use that feedback loop to be what drives your innovation and decision making.
Yeah, I would agree with that. I would also add that one of the things that we do when we're making some of these large decisions, and of course it varies a lot based on the type of decision that you're making, but we always go back to first principles, especially when it comes to looking at new technologies and new innovations. So we say, theoretically, is this possible? Using the laws of physics, is this thing possible? Can we get the unit economics of this new energy storage chemistry down to where we think it will make sense? If we got all of the manufacturing and scaling and commercialization of this type of energy storage mechanism down to kind of the bare fundamental physics, like, is this actually possible? And so we kind of start from there, and then we make certain assumptions, and we kind of build back up. And I think that's important because it kind of resets the baseline of what is possible, but also what can we actually achieve in the near term, medium term, and long term. And that kind of helps us make the right decisions today, tomorrow, and also 5 years down the line.
I think when we're making an initial investment, the number one thing every venture investor will tell you this is just the team. And it's so true that, leadership team that can make those tough decisions when times get tough. Not everybody can do that. They can cast a grand vision, raise a ton of money, but you have to be able to pivot on a dime as an early stage technology company. And that's really hard to do. So that's, just something that we try to look for and kind of test for to the extent we can when we're diligence. And then I guess from a board perspective, to answer your question there, we have always counseled our startups to aim for resiliency and target resiliency because all of this stuff just takes a long time. Any sort of innovation takes a long time, and you have to be in the game to, realize the opportunity when the market does come through and come around. Oftentimes, venture investors are early, And so we want to be able to stick things through, and resilience just in terms of like capital planning, in terms of team, in terms of how you think about investing in your technology and phasing those investments, I think is really important.
Amazing. That was a great question. Thank you very much for asking. We do have time for one more, and I believe, yeah, there is one there.
Hi, my name is Ali from Evolution Energy, and my question is for the whole panel. As some of you guys are Canadian, others are American, I'm just wondering how your approach to investment differs, whether a company is American-based or Canadian-based.
We invest kind of 50-50 across Canada, US. We're trying to deploy as much capital in Canada as we can as a Canadian fund. It ends up being about 50-50. I don't think we look for different things, and in general, I don't know that there's necessarily too big of a gap between the best startups coming out of Canada and the best startups coming out of the US. Certainly, in the US, there's a little bit more aggressiveness just around growth and going big. I think Canadians are always encouraged to dream a little bit bigger, like our southern cousins. So that is something that we talk about with our companies. Are you casting a grand enough vision? But other than that, I don't think there's all that much that's different.
Yeah, I would say I don't think we look at companies based on where they're located or where they're headquartered, but more about where they are planning on doing business and how can we help them best as investors. So, for example, we do have a Canadian company that is in the transit space called Rideco, and they do transit planning. They have a transit planning software solution for on-demand services. It's fascinating what they've been able to achieve. They are entering a lot of the US markets, and that's an area that we can help them a lot with. Sometimes companies come to us from outside of the US, Canada, Europe, and they're in places, or they're trying to enter into markets where we just don't have the right experiences, the right relationships to help them. And in that case, I would say that is a more difficult investment decision for us to make. So we're always looking at, is this company going to be, in addition to kind of all the things that you had mentioned before, Jordan, we're always looking at, is this company going to be in a place where we can help them with the relationships and the networks that we have?
So from the aviation and aerospace perspective, it's really a lot has to do whether it's commercial or defense or dual use. And then what regulatory jurisdiction are they currently under, and what is their go-to-market plan? So there's no one place is better than the other, but if they are working on something, let's say urban air mobility, at this point, it's probably better to certify under EASA than FAA, just because EASA has more regulatory clarity around the path for certification. So without getting into too many details, that's probably the biggest, if there's hardware involved and it's aviation or aerospace, what is your certification plan and what's your market entry plan? And those, we're not biased as to where it's originally located, but if they are planning to sell to the U.S. government, it is helpful to have operations on U.S. soil, for example. So, those are all things that come into consideration, and then what stage the company is at makes a difference.
Amazing, and that takes us right to time. So Jordan, Diana, Sara, thank you so much for the great conversation this morning. Thank you to everyone in the audience for your time. Have a great rest of your day. Thank you so much for joining us.